is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Mike Butler in Chicago, here to take you through the rest of this hour as we wrap up the trading day. If you're on the platform Tasty Trade, on the website tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you think of this market today. What could be the start of a slow week. There's not much by way of an economic calendar the next few days ahead of that inflation report on Thursday, although there are some bond auctions coming up this week that may draw our interest ahead and wrapped around the inflation release. Not like gold and silver are waiting, which continued their extension. Gold at a new all-time high here today. But stocks didn't really get the memo. Some of the tech stocks trading a little bit higher, but generally speaking, it's a market that's modest to the upside. 0.5% of the NASDAQ, 0.2% in the S&P 500. Currency space, the dollar is still getting jammed up a little bit here as those lower rates kick in. Mike, I found this to be a pretty uninspiring equity market one way or the other today. Volatility didn't move. It's still an 11.3 IVR here in ESU5. What's your give us your 2 cents here on this market as we embark upon this trading week? 80% of it left to go.
Like you said, it's been interesting for specific sectors, but on Friday, I had an overarching thesis that we will just chop until the rate cut actually happens. So I put on a 1 day. So on Friday, it was a weekend iron condor that I closed this morning. That was a nice winner, but I plan to do the same thing tomorrow. So tomorrow morning, I'll just place a 0 day iron condor. I just think until the 17th, I think we'll just get some chop until the market tells us, or I guess the Fed tells us that the market's been right or maybe wrong. But I looked it up today. Now we're getting a 10% probability that we've got a 50 basis point cut in 11 days.
It's
here.
12% now.
Oh, sorry. Yeah, 12%. My bad. But
it's been drifting. It's been drifting all day.
Yeah. But if I've learned one thing from you guys, a 50 basis point cut is no good. And it seems like there's a little disconnect between the equity markets that just are drifting higher and gold that's surging, which would imply maybe the markets are going to see some turmoil. And of course, bonds and notes too. So what do you guys think about this? Sell-off incoming, Ilya?
I'm on the same boat as I've been since basically the beginning of August, which is the last time these stock indexes have done anything. And that's really the most interesting thing for me. I mean, if we go back to when CPI came out last time, middle of August, that was the last time that we had any kind of meaningful trend momentum for the S&P 500, say. NASDAQ hasn't even attempted to crack those highs. S&P has been a little bit more chipper. But we established a range top then. We haven't really tried to break it in any kind of consistent way, and we certainly haven't succeeded. And so my playbook has been the same since then. The market knows the cut's coming. That's not controversial. In fact, the market has been at 50 basis points, matching the Fed's stated cadence all the way back to December, at least since May. So the markets have known what the policy is for this year. The big question is next year. And next year, there's a huge disconnect between the Fed and markets. So I think the big thing from the Fed this time isn't going to be the move. Unless, of course, they do decide to throw a grenade out there and make it 50 basis points immediately. I think the big question is what's going to happen next year. And there, the Fed's been saying only 25 basis points. The markets are closer to 80. So we're going to have to see some sort of movement on the summary of economic projections in a dovish direction, or I think the market gets upset. Because if you look at these dynamics and sort of the way that the S&P has behaved relative to the outlook for Fed policy through the end of next year, it's been as clear cut as you can possibly imagine. When you get the rebound in stocks from April's lows, the outlook gets, understandably, less dovish because the fear goes away. That ends by mid-May. And from there, the outlook for this year is steady. The outlook for next year is getting increasingly more dovish. We are now more dovish in aggregate than we were in May. than we were in April, even at the lows, and stocks drift higher. Could it be that this move in stocks was first, oh, good, Liberation Day isn't a guarantee, but then a month later, okay, rate cuts? And if those rate cuts aren't coming in this kind of volume, that's a lot of upside momentum for stocks that all of a sudden looks mispriced. And sound.
Thanks for that. I always want to just mute the sneezes here. People don't want to listen to me sneeze, right? So we go to a market on Friday where obviously we have the big reversal coming into this week. Will we hold on to that? Will we find continuation? Or we really don't, Ilya? In a certain sense, it kind of reminds me of what happened at the start of August, where you had the big move on the Friday around the jobs data. Europe and Asia come take the baton for the start of the trading week, and they do nothing with it. And so then
they decide not to go. Yeah.
Right. And then U.S. equity traders today, they push up the market a little bit after Asian and European traders, again, don't take the baton and run it to the downside.
Yeah.
Looking at the sector performance here today, I don't think it's going to surprise anyone that the top two are GDX and GDXJ. But for the sake of equity index companies, SMH here is your top performer. Broadcom at the end of last week had a really strong performance. Today, it follows it up with a 3.26% gain. Mike, I'm looking at some of these individual companies that have been leading the charge to the upside, like your Broadcom, your NVIDIA, your Meta. Where's the volatility? I thought August and September were supposed to be the big vol months, according to my little abacus here. How do we deal with a 2.1 IVR in a stock if it's not just Broadcom, but any of these big names?
Yeah, I mean, the earnings this quarter have been pretty wild. Broadcom had earnings a couple days ago. They've had a pretty decent range over the last 2 days, but yeah, volatility's just been crushed in here. I think a lot of the implied volatility that was propping up the IV ranks is now gone, because basically, obviously after an earnings announcement, you're going to get a vol crush across the board, and the VIX is low. So I think a lot of these companies pre-earnings had decent IV ranks, but now with nothing on the horizon in terms of a binary event, you have a bunch of these equities in the 30% range, which is always going to be a low IV rank reading. So yeah, I mean, it's tough to say whether these companies will actually find any reason to come down unless the overall market goes down with a vol pop, because the VIX right now not looking great, sitting at 15. And more importantly, the vol futures, we've got significant contango right now between the V and the X contract, and both of those are under 20 now. So it feels like the market's telling us nothing to see here, but it seems like we think that maybe this is going to be moving around, at least when the announcement actually comes out, whether they're doing 25 or 50 basis points. For whatever reason, I feel like the market's going to sell off when they do the cut. In a rare turn of events, I think I'm in line with Ilya here, that when the rate cut hits, whether it's a 25 or 50, everyone gets faked out with a nice big sell-off.
Yeah. And yeah. And I mean, I think the reason for it will be that the cut's not anything like news for anyone at this point. And if the Fed doesn't come through and say there will be many more cuts next year than we said before, even just one more, even if they go from 25 to 50 and the market's at 75, if they at least see some movement in their direction, they'll probably find a way to say, okay, fine. But if there's no movement and the commentary is we're still more concerned about inflation than employment, especially while you get signs the economy is reheating. Look at the ISMs, look at the S&P Global PMIs, the tone of data, even just looking at the Atlanta Fed GDP Now model, it wasn't updated strangely on Friday. So you can actually see it up and just ahead of Friday. GDP expectations for third quarter are not anything to be taken at face value this early in the game, but you can see the tone of the data. and the tone of the data has been positive. That's not a situation where the Fed is going to go, oh yeah, let's be ultra dovish right now. So they'll give the 25, I think, and not the and not the 50. But the more the markets get hopped up on maybe it's 50 and it'll be 75 next year, and the Fed says no, actually it's 25 now and 25 next year, and then there's another one here somewhere in October, December, I think the market doesn't like it.
You know, it's interesting that you talk about the Fed potentially going 50. That is an idea that we've kicked around here for several months, right? If they're going to do it, they're going to go 0 or they're going to go 50. Even though the market's only saying 12% chance. I would point to the inflation expectations that have been coming off the board. You can see the downtick only slightly here, but we've had a little bit of a pullback in recent weeks where forward-looking inflation expectations are starting to come in. And the Fed's own model of where like 10-year yields should be, for example, they're suggesting they should be a bit lower from where they currently are. The point I'm getting at, though, is that if you're the Federal Reserve, you could easily make the case that looking around the corner and how, again, the NFIB charts about job expectations, right, and how the economy looks 3-6 months out, individual consumers' expectations, the rise in consumer credit card debt, by the way. Did you see that today? Consumer credit card debt jumped to $16 billion. The expectation was for it to go from 7 to 10. So people are spending
and
money.
Inflation expectations went up.
Well, you could point to enough of a decline.
Markets. Not in the markets. The survey, and that follows the U of M one that jumped. In the markets, of course, break-evens have been pretty lackluster since they bottomed in April. And this has been the market's whole logic, that the Fed is wrong to worry about inflation, that they need to worry about the growth outlook. And that's been sort of behind this shift to ultra dovish expectations for next year. The markets have been screaming at the Fed, you're worried about the wrong thing, basically for 4 months now.
Maybe. The fact that 10-year yields could be breaking below 4% this week, I think, is noteworthy. The last time we saw that, of course, was in May.
Totally.
Excuse me, April, right around Liberation Day. So this is a different kind of move down here, of course. It's not like a panic. But if lower rates are coming, Ilya, that does cause a problem here for our beloved U.S. dollar, which, my exposure is Canadian dollar, euro. The euro's breaking out now.
I don't know. I mean, the only one that really looked like it broke out to me was the Swiss franc. Everything else is basically at its anti-dollar range extreme. Yes, if you put a sloped line on here, it does look like it's breaking out. But I trust sloped lines very modestly because it's all very much in the eye of the beholder.
You're horizontal, man.
That's right.
As Josh would say.
That's right. And when you look at this, you go, okay, well, we're at the top of the range. Are we actually going anywhere? The pound looks the same. The Aussie looks similar, though it's a different range top. The Canadian dollar looks probably the weakest of the bunch. The yen looks the same. The Swiss franc was really the only one that broke out higher last week in a very kind of convincing way. And this one I just got out of. Like, I was short this. I am no longer. I took a little baby loss of less than 0.5% of equity, and on we go. But everywhere else, I'm still long dollars because I don't think it's really made a move. And considering what the bond market is doing, I mean, yields are, I don't want to say crashing, but they're certainly moving lower in a hurry. And the dollar isn't breaking its ranges. It should be getting absolutely tanked, but it's not. And that, I think, is interesting. I'm not sold on the idea that the dollar is done bottoming here.
Well, I mean, you look at the positioning data right now in the market, Mike. I mean, I see a market that's still very short the U.S. dollar. Surveys show that it's still the most hated trade by institutional investors, being long the dollar rate. Most everyone is the favored short trade of the year so far has been dollars and remains U.S. dollars. according to Bank of America's fund manager survey. But I see some higher volatilities in the space, particularly in the futures options here. Maybe not in Tasty FX world, but at least here on Tasty Trade world. An 88.6 IVR in the Canadian dollar, the euro, which is way more liquid, still up at 36.1. Why not sprinkle in something like a directionally neutral, what have you, at 60 days out right now, Mike, and try to play for some more chop, even if maybe give some room to the upside if the dollar's breaking. These are pretty decent risk to rewards, risking a little bit less than 8 to make 4.5. That's better than a 2-to-1.
Yeah, I like the neutral trades when it feels like the markets are waiting for something to happen or a decision to be made. It feels better to place for sure. I'm long the US dollar for better or worse, but it's like really small. So I just use the Tasty FX products. We just look at daily ranges and we place some short euro dollar position, a long dollar yen, a long dollar franc. But those positions are so small that they won't really be meaningful anyways until they move in our favor if they do. But yeah, I think when you have this period of time, which we're in now, that basically suggests that the markets aren't moving anywhere or anywhere substantially until September 17th. I think a lot of these markets will kind of have a wait and see approach. But the big move to the upside, the huge bid in gold, I think is really interesting and maybe a little telling of what we can expect. I feel like the move in gold, unless I'm missing something drastically, I feel like the move in gold is more of a, we're not sure how the market's going to react to whatever's going to happen on the 17th. Let's just get into something that could see more upside if there is going to be more turbulence in these markets. But SPX implied volatility through September 17th is only 90 points. So that's a really narrow range for 9 days, in my opinion, with such a question mark still on the table. I feel like at this point we should be looking at what we were looking at last week, where you had a 98% chance of a 25 basis point cut, and now there's more uncertainty being baked in on the other side of the curve.
It's really interesting that you mentioned that about the only 90 points, though. Like, we're talking about under 1.5% trading range until next Wednesday Fed meeting.
Yeah.
You can see the jump up here. It's like 7 points, 5 points, 8 points, 4 points, right? The market's pricing in barely anything additional around the Fed itself the day of.
Yeah.
It's kind of wild.
It is wild. But these, like this, if there's a time, I'm going to put this money where my mouth is here. If there's a time to do like the 0-day neutral iron condors, I think this is an interesting time, because if it does pan out that way, where we just see really narrow ranges and low volume, the 0-day iron condors should be okay. So we'll be back in tomorrow.
Yeah, let's just put that up on the screen here real quick. So we want to do 1 DTE for this. I guess we're going to go to 0 if it automatically places us there. No, you're not helping me. So we'll just do it ourselves manually. We're going to go over to the 1s, Mike, because that would be tomorrow's expiry. The expected move, small, talking about 25.5 points in either end. So just straddling the 1 standard deviation expected move. If people wanted to do what Mike does, be like Mike. That was a thing from the 90s. 62% probability of profit, risking 3 to make 1. 130 gain, 370 loss, buying power 370. It's just expecting the market to do nothing until we get a reason to do something.
Yeah. So I did this on Friday. I had a similar max profit, max loss. I got $1.90 because I had the weekend risk in there. But we were sitting at, my short option was at 6,500 today. We were sitting right there, and then we got a little bit of a sell-off intraday, and it went from a scratch to a $100 winner. So just make sure if you're doing this, you have your GTC order in to capture some profit, because it can happen quickly if you get a tiny move over the course of 5 minutes.
Mike, I like this. Let's just get this on the board so it can start working and send it in the next session. But yeah, this makes a great deal of sense to me. Tomorrow, Ilya, I don't see anything on the calendar that's going to meaningfully move us. Sure, there's something that could happen out of DC, but there's always something happening out of DC. It's become so much background noise for the market at this point in time. I could probably point to 4 or 5 news stories today that a decade ago we may have seen market movement on. So what's
tomorrow, by the way, the annual
note auction
revision for the annual revision for NFP. comes out.
Yes, that's the one that last summer when it came out, we heard that it was proof that the prior administration was fudging jobs numbers to prop up ahead of the election. Okay, so like this is then something that's interesting for the market. What was it last year? Minus 818,000 jobs.
Minus 818 last year. Obviously, that was a huge revision. I don't know if we can even say that that's such a huge revision this time, considering not this past NFP, which was only revised down by 21,000. Which, by the way, that's a fun thing. You get a 22K rise in jobs, and the previous months were revised down by 21,000. So what, you added 1,000 jobs? That's nice. But anyway, the preceding month had a revision of 258,000 just for the month. Now, that's a big revision, and it's spread over a couple months of prior revised data, but you figure there's at least some kind of a level of acclimation in the markets to these big triple-digit numbers. I mean, if we get the annual revision here and it's, let's say, bigger than it was last year, let's say it's approaching 1 million jobs, let's say it's more, is anybody going to be that shocked? I'm not sure. I doubt it. The PPI numbers on Wednesday, though, that might be something because it comes out before CPI this time. Last month, it was the other way around. And this is where you've seen the tariff inflation really start to show. So if you get a sense ahead of CPI that more and more of these prices are getting passed through from the beginning of the supply chain down and towards retail, that's going to be interesting stage setting for CPI on Thursday.
Could be interesting stage setting for CPI on Thursday. We had we have CPI and PPI that came out last month. Ilya, they pointed to inflation that could be closer to 0.5%.
Yeah,
you just
PPI especially because the where businesses before basically last month were eating the tariff costs and saying, okay, let's not kill demand. This thing is, let's say, vague enough that we don't want to front run. They threw in the towel in July and basically said, okay, you know what? We're building our margins back out. You all pay for this. We're not going to do it.
Everyone's doing it. Even that lovely little Asian market in South Park, Colorado, Mike. Everything can be blamed for tariffs these days. I don't know if you saw the most recent South Park episode.
I need to check it out.
It's all about Labubus, which is just a terrible thing to have in your child's life.
The little like rat looking things. Yeah.
Yeah, my daughter got on that too a few weeks ago.
Mine too.
Yeah. There's a pharmacy in town that's selling them for $60 a pop.
Well, you know how everyone's
my
obsessed
daughter
with
is content to watching them on YouTube and then sketching them.
Oh,
you know the little gotchas, the little vending machine twister things? Yeah, you know. McDonald's just made little gotchas. So that's a genius marketing. Like that's when you know the pulse of society, when you've got McDonald's putting out little gotchas of like cash registers and soda machines. This is where we're at.
They're bringing gambling from mobile apps into the real life.
Yeah.
Where it's like spend $99 and get this mystery box.
Yeah.
And you're like, ooh,
they opened a
box.
shiny new arcade in one of the malls here, and an entire section of this arcade is dedicated to mystery box.
Yeah.
Machines of various size, stripe, and cost.
Yeah. They're everywhere.
Can we get that on the platform? PMRTY? Yeah. Pop Mart. Look what you've done this year. This is a Labubu company. Started the year near $12, now up at 37.
Classic.
PMRTY, Pop Market International Groups. It's the ADR. I digress from childhood consumption issues. So we have a market that's pinned. Volatility even here after hours coming in a little bit. Top performers in terms of today. We were talking about SMH before, and then of course what was happening with GDX and GDXJ. But that's not the only thing that's happening in this market. I couldn't help but notice that XLU is coming in. Okay. Utilities have been a bellwether for the broader AI trade. Issues around electricity generation in the United States have been drawing a lot of attention over recent weeks, in part because there is a meaningful impact in inflation from these higher electricity costs. And so a lot of folks are coming out against it. I saw that not only are we watching XLU come in, but I got this great chart earlier today from Torsten Slok over at Apollo Global Management. AI adoption rates for larger firms starting to decline. It looks like we may be flatlining a little bit here. Mike, before Ilya says this is the adoption of the railroads in the late 19th century,
The
why
Economist
should
did a whole story about it this week.
my blood
Railroads
pressure's
and
going up?
telephones and whatnot.
My is this the new headwind for the space, Mike? That like AI is not delivering real results and real productivity boom, and we've all just been buying castles in the sky. Meta is 20% of NVIDIA's business right now. So if big firms are not adopting as quickly, isn't that a problem for the chip makers? Today's top performer?
I think we're in an interesting spot. I mean, we've seen firsthand how powerful AI can be, even on the tastylive network and at Taste Trade too. But yeah, I think the initial shock, it kind of reminds me of like a Tesla, where Tesla was talking about doing X, Y, and Z, and the stock was just mooning. And now it's like can't buy a bid because of everything going on there. But every story has its little I don't want to say bubble now, but every story that is just pure euphoria has its kind of bottoming out. Maybe eventually we just keep skyrocketing, but I think there's definitely some issues at hand in terms of the scalability of the immediate impact it can have. Like, of course, everyone can have an AI agent that helps their support team do X, Y, and Z and automate everything.
I tell you what I've had an AI agent doing. I created a custom email address just to test this out and I have it, and I gave it to two people, the email address, like, hey, I switched my email address. And I set up a bot there to respond to them at random intervals to let them know that I'm thinking about what they emailed me about, but I don't have an answer yet. And I forgot to set a limiter on it when I first set it up. So when I went in there the other day to like take a look at the conversations, I had eenemailed one of my friends 18 times in the span of like 7 hours to let him know that I didn't have an answer for him.
My God, that's amazing.
And I only found out because he gave me a call and he's like, I need to know what the plans are. Like, what are you talking about?
You're emailing me every 30 minutes saying you don't know still.
Nope, I'm like, okay, so that new email,
nope.
You may have been a guinea pig. I love you, bro.
That's incredible.
So we're experimenting around here.
Yeah. I mean, I think AI will change the face of a lot of the things that we see now or have seen in the past. But I think it's a kind of a similar story to crypto. Like the power of crypto isn't necessarily just buying Bitcoin and forgetting about it. It's kind of changing the way that things are processed under the hood. Like stablecoin funding. Like the fact that you can fund your Tasty account with stablecoin now allows international traders to bypass some of the international wire fees, and you get your buying power immediately, et cetera, et cetera. So it's like those kinds of things are, I think, going to be more impactful from a crypto standpoint. Just like AI, there's going to be things in AI that we don't necessarily understand yet that are going to be embedded in a lot of these companies' infrastructures. And, maybe that's it. We're in a figuring it out stage.
Well, the good news is that we did pass the Judgment Day anniversary. Skynet goes live on August 29th in that future, whatever it was. Now, granted, it was 1997, but still, nevertheless. You mentioned the cryptos, though, here, Mike. I do want to delve into this a little bit more. What's happening with the crypto space now? I've seen a lot of depressing feeds from people selling their Bored Ape Yacht Club JPEGs in recent days at massive losses. This is not something that happens when sentiment in the market is very high. And it makes me think that we're actually been in a little bit more of a drawdown here. Ilya, I know that you don't think the space is any sort of legitimate, but for those people who don't like gotcha boxes, Mike, but we will play with crypto.
Yeah.
what's going on in the space right now? It feels like this is maybe the chat has an opinion on this. Chat, you tell me, does it feel like something's off in crypto world right now, that vibes are bad? Because that's my read on it.
Vibes are not necessarily great, but I think one of the things that we've focused on specifically when we've had Ryan Grace from the Tasty Crypto team on every Monday. He's out on paternity leave, so congrats to him. But one of the things that we focused on was the Bitcoin dominance ratio. So Bitcoin dominance was super high 6 months ago, and everyone investing new flows was basically going to Bitcoin. This was all the while Ethereum was down at like 1,500, 1,600. And the trade was, if you believe that Bitcoin dominance is going to come down, where are the funds going to go to? Products like Ethereum, products like Solana. So we were talking about this Ethereum trade. I mean, it came to fruition way quicker than we may have imagined. But when you look at crypto as a holistic entity, there are certainly trades within that if you dig into it. So it's still funny though. Like, we're talking about how Bitcoin feels like it's dead, blah, blah, blah. It's still at 120, 112K. And someone in the YouTube chat,
Mike.
Oh yeah.
Might as well be zero.
Yeah. Someone in the YouTube chat actually said, I forget where it was. Let me see if I can find it. It was something along the lines of, I think we will see interest rate cut hit, markets will drop, and gold and crypto will go up. So do you think that crypto could be a haven for equity funds that are leaving the equity space, going to gold, crypto?
Elliot, can I make a point before you jump in here?
I mean, I have a one-word answer.
Yeah, he just says say no. You can say
I know he's going to say no.
Simple answer is no.
I know.
Stop it.
Okay, so in terms of economic forecasting, you and I have touched on this a little bit, but now I'm blanking on his name, but Goldman Sachs chief economist was just won a distinguished award for his accuracy and predictions over the past 2 decades. He called the global financial crisis in 2008. He called the post-COVID market to a T. Okay. He pointed out that he just tracks the business cycle. So let's just simplify this for everyone here. Where are we at in the business cycle right now on monetary policy? Monetary policy looks like it's going to get looser, expansionary. Fiscal policy is expansionary, maybe not for the 80% of the population, but for the top 20% that play around in the stock market and financial assets, it's certainly expansionary. Is that just the story we need to know, that monetary conditions are loose, that fiscal conditions are relatively loose, and deficits going up with low rates tends to be asset inflationary? I mean, like, why overthink this? In the spirit of a Dylan Radigan who's not here, why think at all?
Because I think we know all of these things, and this is what we've been looking at since, again, about mid-May. And so there's nothing here that needs to be priced in further. Unless, of course, the Fed decides to go the market's way. Now we have to find out whether the Fed is going to get off this inflation is our greatest fear thing and tell us next week that they're going to go the market's way on rate cuts next year. Then you have some validation. Otherwise, we're priced for it. Since mid-May, we've been at 50 basis points, give or take a few here or there, depending on what's going on in the markets for this year. The Fed told us that was going to be it since December, before the tariffs appeared, before the new administration even got into office. So that's non-controversial. The markets have been going up for certainly a combination of reasons, but one of the big reasons the markets have been going up is the markets, again, since mid-May, have increasingly diverged from Fed forecasting. The markets have gone more dovish. The Fed has gone less dovish for what happens after this year. The Fed revised in June from 50 basis points to 25. The markets revised over the same period. And now, because they've continued moving, the Fed's stopped all the way out to almost 80 basis points. So we are now at a more dovish outlook for this year and next year than we were at the absolute maximum pain point in April And this year hasn't really moved. It's all next year. So, sure, I mean, don't overthink it. Just don't assume the markets are going to think this same thought in perpetuity. At some point, things do get priced in. And they've been, at this point, so priced in that the markets are now meaningfully decoupled from what the Fed is saying to the tune of at least 50 basis points. So if the Fed doesn't deliver, now there's scope for disappointment. And as far as fiscal policy, what loose fiscal policy? The president is out here touting this many $1 trillion in tariffs. That's a tax hike. What
we have 17
policy where?
We have $17 trillion coming into the country, Elia.
It's 17 now?
It was 17 over the weekend, yeah.
Why not just go the 20? Give us a number with a zero at the end of it.
That's too, Mike, if he's like, oh yeah, we raised exactly $20 trillion from tariffs, would that be believable? No, 17 trillion is a much more believable number, right? $17 trillion.
It's got to be 17.3 then to really nail.
That would convince me.
Yeah, I would be sold then. But I mean, what are we looking at? What expansive fiscal policy are we looking at? We extended tax cuts that already existed. No stimulus there. And we've introduced a giant consumption tax.
Well, there are more tax cuts coming for the upper income deciles for sure.
But they're not spenders.
You and I have talked about this. Like, we're both getting tax cuts from this
because we got SALT reconsidered in the big beautiful bill.
So we're going to give Californians, New Yorkers, people from Connecticut, New Jersey, Massachusetts,
homeowners specifically.
Okay, wealthy homeowners in rich states more money to spend. What are they going to do with it?
They're not going to spend it.
Do you think they might put it in the stock market or gold?
Crypto, baby, Bitcoin.
So I'm saying, like, where does the money go? What are you said this to me earlier? Water always finds a level. Capital's like water in the global financial system.
That's right. Always finds a level.
Where's the level? Do you think that we should be investing in treasuries with the 10-year note at 4.05%? Is that enough?
I mean, it seems like it's found a level, which is why you have now this disparity between the markets and the Fed. And the question is, did the Fed get religion between June and now? And you look at the FOMC minutes, you look at what Powell was saying, and the answer is no.
They didn't get religion. But hey, recession might be coming because when gold and bonds fly, that's usually what it means.
Yeah.
Right? Post non-farm payrolls would have been the two best performing asset classes. CB, GC.
Well, and you load up consumers with a giant consumption tax. They're going to be so excited about consuming. We already had the first 6 months of this year give us the weakest consumption since the quarter that was the onset of COVID, the first 6 months of 2020. Like, that's already occurred. And in related news, as it were, at the end of all of this, this week, we're going to get the University of Michigan consumer confidence data. Never mind the consumer confidence. It's already going down significantly. But more importantly, inflation expectations. They're rising again. They jumped back up to 4.8% in the last set of numbers. If the PPI numbers are telling us anything, it is that is only going to go higher. So we have an economy that, at the very least, is hampered by the fact that 68% of it is household consumption, and they have to pull a giant tax hike now, which is what these tariffs are.
Yeah, there's this chart I saw mocked up on Twitter earlier. It comes from Amanda, just make sure I get her name right, Amanda Goodall at the Jobnik. Don't know anything about her, obviously. Shares are not endorsements, but charts like this are. Credit card usage, revolving debt in the most recent report was up 9.7%. Debts otherwise are not really moving. And Well, what have been the most recent interest rates for those debts that are rising? In the 20s. Okay, this is a big problem for people. Americans like to fund their lifestyles and they continue to spend the money to keep the lifestyles afloat. We saw this in the vibe session, Ilya, in 2022,
Yeah,
right? Everyone was miserable, but no one wants to give up the sense of feeling that they developed during COVID when they were getting stimmy checks and working from home and conspicuously consuming and ordering everything to their house, right? Like, how used did we get to, private taxis for our burritos, as the saying goes? And people may be losing their jobs and employment slowing down, but people are still spending the money. So, when do we run into that wall? Maybe it's another data point why we need a rate cut, although ratcheting of the interest rates doesn't help on the way down the way it does on the way up. Credit card companies aren't that lenient with giving you better rates very quickly. I don't know, guys. I walk away from this. Interest rates are low, so where are you going to put your marginal dollar? I feel like a total jagweed, Ilya, for not being on gold for the last $80. At least not through the options, because you know how much fun I have through them. Or is this just going to be a march higher now?
I'm still sitting long, and it's working and good.
And don't touch it. And don't make my mistake. Don't make my mistake.
I got tons of duration left in it. I'm not going to mess with this. It seems like it has done something that isn't necessarily even motivated by the Fed or rates. Only Friday did the bonds sort of start to validate this. Gold obviously started this move much earlier. And so, and the dollar, again, weak on Friday, a little bit more today here and there, but again, not breaking any ranges for the most part. So this seems different. I think Mike said it earlier. It's more so a reflection of increased uncertainty than it is sort of defined risk aversion or defined policy outlook. It's more like, you know what, let's allocate more this way because there's a bunch of touch points ahead and who knows what happens now. In part, I think you turn to these Supreme Court cases looming and you go, okay, is it possible that after we've spent basically 5 months figuring out that the tariffs are going to be this or that and sentiment recovering from that, what would it do if all of a sudden now the lower court decision was upheld at the Supreme Court or even kicked back and the Supreme Court said, you know what, we're just not going to take this up. And the whole thing ends up being illegal. And most of the tariffs just fall apart. And then we have to pay back, what, about 200 million? Sorry, 17 trillion. Wait, what? What was that number? Whatever. But we have to refund all of this money. It's just a ton of uncertainty. And I think that's what gold is responding to here. I don't see any reason to overthink this one whatsoever.
Global GDP is like 85, 90 trillion dollars from the most recent data that I've seen, Ilya.
Yeah.
So other countries are gonna just lob off 20% of global GDP and shunt it into the US economy over the next few years.
We're not gonna have an inflation problem, even if that works, because magic fairy dust will fall from the sky and zap all the inflation on contact.
I don't know. This all just, where I stand on this, Ilya, from day one. So the fact that we're now going to like this now publicly, patently, absurdly just make up the numbers to convince people of a narrative kind of thing.
Yeah.
Hey, gold and Bitcoin still seem great from that point of view. Right.
Well, that's the whole thing, is not Bitcoin, because gold is surging and Bitcoin's not. In fact, it broke its range and it's coming down. So I've got a nice spread going de facto here. I've got a nice put vertical on IBIT because you can trade short Bitcoin now with the right vehicle and not go crazy on the size. It's 4.5 to 1 risk reward in there if you want to take the short side. Very, very attractive.
You're doing the Peter Schiff. You're doing the Peter Schiff. Long
Basically.
gold, short Bitcoin.
Essentially.
Spicy.
That might be the first time Peter Schiff and I have agreed on anything.
Well, he's been short Bitcoin this entire time. So whenever you get long gold, you and him are in the same boat, I guess.
I mean, this is the first time I've been short Bitcoin or had any exposure to Bitcoin at all.
Mike, have you ever seen Peter Schiff and Ilya in the same room at the same time?
No, but it would probably be just popcorn inducing entertainment.
I think they might be the same person.
Just get the conversation started on the Fed. You'll find out very quickly the distinction between the two.
All right, Mike, we got 10 minutes left here. To me, this is I don't want to say it's a dull market today, but it's kind of a dull market today. You get some more directional moves in the metals, which obviously is nice if you're long them. I'm still leaning long silver, been sitting on those $42 calls for several weeks now. There's still 40 odd days to expiration in here, 50 days to expiration in here. So there's really no reason to even look at it yet, as long as the line continues to go up. That's probably the best trade I have on the board right now, next to the directionally short crude oil, just expecting more chop around this like 63, 64 area. I've had some things that haven't worked. My Friday reverse iron fly mismanaged. I always say I'm a bad scalper, and it's because we touched the high of the fly, then we touched the low, and I couldn't make any money on it apparently. So sticking with what's working for me has been long metals, has been directionally neutral energy. Going to keep pressing those levers this week. Mike, what's been working for you, and what will you do less of perhaps in the days ahead?
What's
aside from the SPX Condor, of course.
Yeah. Those have been nice. Those have been great. But what's working for me right now? So 3 trades I closed this morning for profits were all related to buying the dip. So actually, Delta Airlines was a strangle. That was just a neutral trade. Rocket Labs, RKLB, that was just a high implied volatility. We call it the stupid. It's where you sell a put to finance a long call spread and you route it for a credit.
Yeah.
So you're
the
basically
double bull.
Yeah. So you're shifting your short put premium max profit to a debit spread max profit, but still routing it for credit. Microsoft, that was a nice trade. It was down like 13, 14 points on Friday. So I bought a call diagonal spread, long the 500, short the 510, October, September. That was like $130. But really what's the best trade I've had all year is just having short premium on in IBIT. So to Ilya's point, whether you're bullish or bearish, this product still moves and it still has an implied volatility. Even though IV rank is low, still has an implied volatility of around 50 in the October, November cycles. So I've had a strangle on all year in here. Started with a $500 credit. I've worked it up to a $2,300 credit, and it's marked at $400. So this is a $2,000 winner right now. With $2,350 in credit, I have a 65-75 strangle in October, which brings my break evens down to like 40 and up to 90. So unless something insane happens, this is going to be a great trade. But every time I roll, because it has high implied volatility, you get $1.50 or $2 each time you roll. So this is something I'll probably do into perpetuity. My whole thing is I don't want to have short delta in here, unlike Ilya. So if we get tested on the upside, instead of just rolling the put up, I just shift the whole thing up so that my short call tested becomes my short put tested. And that way you kind of just inverse your delta. And it's been a really powerful strategy. I think it's something that I've been talking about. Like if I had a couple $1 million, I would just sell a put in SPX or a couple puts in SPX and just have that be the core position. But kind of this strangle is really nice when you shift it higher. So you're not worried about having short delta in a market that's just grinding higher. But yeah, that's been the best trade I've had all year is this IBIT strangle for sure.
It's a great idea.
It's well executed. I mean, Mike, you've been harping on me about like, and I hear this from Nick too, directionally neutral in gold and Bitcoin since like May. And I've been some fool taking upside shots in here and like getting ever so close to grabbing that sun and it melting out of my fingertips and falling back to earth every time. So yeah, I'm still leaning long. This to me is the line in the sand, Ilya, for what it's worth. Right, we're kind of pinned up against that May high. We're hugging the low that we had in early August.
That's basically where I sold on the idea that there's a range break here and maybe we'll get some extension. So we'll see if it breaks.
Well, that's the story here.
Back into that range, then my trade's wrong and I'll get out.
Yeah, no, this is the thing. Like, if we don't break back into the range here, then it's good night nurse for me. And holding out hope. Downtrend broken. Maybe this is a little wedge in here, right? Fun with technical analysis, drawing shapes, right? There's your wedge, starting to break out of it. We need to get through 64.5 tomorrow in IBIT. So I suppose in the BTC world, right, what would give us confidence in the upside, get us back through 14,000, and then start to try to close that gap. This is a stupid gap, by the way. This was a stupid sell-off, by the way. Do you know why this sell-off happened? Here on the 13th of August, going into the 14th, it was announced that the Trump administration would not be revaluing the gold in Fort Knox to use the official markup proceeds to then fund a Bitcoin strategic reserve. And we wouldn't be taking out any debt to fund a Bitcoin strategic reserve. We would be using whatever Bitcoin we confiscate, and we would be warehousing that effectively. Those would be our strategic reserves for Bitcoin. So the government's not going to spend an additional dollar you're issuing debt to buy Bitcoin. Okay, so there's a sell-off here. The market's a little disappointed. Uncle Sam's not opening up the purse. When does that wash out? I mean, this is as good of a place as ever for it to wash out for me, near 110. The highs that you have in December and January of last year, where we run into the rally in May, right? This seems like classic resistance turn support. If it is, it's time to prove it.
Right. And if you look at it, you can see that from April through to now, this looks more like the S&P or the NASDAQ than it does gold. So any kind of sort of thematic conversation about this is anti-fiat store of value, stop that. Just look at it. Just eyeball it with the naked eye. What does that look like to you? Does that look like the gold chart, or does it look like a chart of the S&P 500 or the NASDAQ? It's not rocket science, folks.
Looks like something that's about to rocket ship. Looks like it's coiling, ready to blast off to 150.
Or down. We'll see.
Or down. That's true.
Or down. We'll see. It does look like it's coiling. I think the step down through its range bottom that it took last week may be the start of something. And if it's not, then we'll find out soon enough. In which case, I'm going to get myself out of this position. But when the risk reward is 4.5 to 1, where you get to risk $200 to make almost a G, I'll take that punt. Sure.
I got a different punt for you, Mike. If we close above 64.5 tomorrow in IBIT, that means we're going to be through 114K in BTC. That sets us up, in my view, for a move back up to 125K. The equivalent there is basically 70 in IBIT. And thinking out structuring trades like this, risking 8 to make 400, so like 5 to 1, kind of in that neighborhood, close to it. That's the kind of upside shot I'd be willing to take in Bitcoin. If we can start to close the gap after this whole disappointment that the government's not going to send us tendies, as I saw on Reddit in August. I'm selling my Bitcoin because the government's not going to be propping it up officially. Okay, well, that was a good trade if you did it back then. But that's not is that why Bitcoin's been going up over the past year, 3 years, 5 years, 10 years? Because people think the governments are going to print debt to buy Bitcoin? I've never heard that argument.
For excuses. Now we're just for excuses.
You're just making things up if that's what we really were basing our bullish thesis on. Okay,
so the whole thing was supposed to be the government isn't involved. That was kind of the whole essence of what this was going to revolutionize. How far?
I don't know about that. That's not my read on it. I watched this documentary a few years ago.
Not my read on it either, but that was sort of the cyberpunk conception, the people that invented this thing.
This is a long documentary. It's worth the watch. I swear by it. It's not a personal endorsement. I don't know the people who made it, but it's from Folding Ideas. It's called Line Goes Up, The Problem with NFTs. It's a 2.5 hour documentary. It's been viewed 17 million times on YouTube, so it's not like a little niche thing. And it talks about the origin and genesis of crypto. And one of the things that stuck out to me was when you look at the early conversations in the Bitcoin chat groups from the 2009 era, it was really all about hey, the banking system crushed us. Wouldn't it be better if we had our own system that we were in charge of? So we want to wear the boot. We don't want
No,
the boot on
exactly.
our neck. We want to be the people wearing the boot.
Exactly. Exactly.
Fascinating.
This whole thing was anti-establishment in its conception. And now we're praying that the government is going to put a bid under the market.
How about this though? How about if we get, so over the next 9 days up until the 17th, if we get a move from Bitcoin from 112 up to 120 and we see gold continue higher, to me that just screams whatever they do on the 17th, the market's going to sell off.
Oh yeah, stocks are going to get clanked 2%, 3% loss easily.
Yeah.
But
Yeah.
hey, time will tell. And until
like
that
it.
point, I will be selling 1 day or 0 day iron condors.
Mike, with
You're
that, I'm in line with
you're
you.
a wiser man than me, sir.
I'm in there with you for tomorrow, which I suppose is a good time as ever to say with that, overtime is out of time. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I'm in Chris Vecchio in New York. Good luck trading. Don't go anywhere, though. Tasty Live at Night coming right back at you, starting with, well, Ilya, Macro Money up next.
See you there, everybody.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
What's your sleeper pick for the second half of 2025? Is there anything that you're particularly high on nobody's talking about?
My sleeper pick. I think Ethereum is an interesting play. It's still a lot. It's near the lower end of where it's been trading at 2,500-ish. If you are bullish on the crypto space, which I am, and I think the blockchain technology is a huge part of that, I think that Ethereum has a little bit of a catch-up trade, and you can now trade it via the ETFs. ETH-A is the Ethereum ETF, which is now accessible for option traders. So I think that's an interesting play.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
Well, it was a quiet start for the markets on the first trading session after that very disappointing jobs report on Friday. We don't ultimately go very far, at least as it touches the stock market. S&P 500 kind of idling here, a little bit higher, but ultimately not going anywhere relative to where it closed on Friday. A little bit of a nudge up for the NASDAQ as well, but also well within its familiar range. A lot more of a fireworks display still ongoing in gold and the bond market. So what are we going to do this week with the Fed looming just a week and a half from now? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and we have no shortage of meaningful event risk that's on the board this week that can very potently influence expectations for what happens when the Fed does finally pull the trigger. So, is this going to be the calm before the storm? Maybe so. And by the way, that storm can be bullish, it can be bearish. We just know that the 17th is a major touch point for these markets one way or another. But will we have a sort of period of drift before? Well, maybe not, because the assortment on the calendar this week is, let us say, non-negligible. First, here's how we fared last week. We can see stocks still relatively listless, 0.3% gain after a 0.2% decline. Not really going anywhere on the S&P. NASDAQ had a little bit of a better week, up 1%, but still within familiar range bounds. A much more spirited performance in the bond market, yields cratering, down 3.7% in the 10-year, down 3.1% in the 2-year. Most of that happening courtesy of the U.S. jobs report, which we'll get to in just one moment. Crude oil still kind of doing its own thing, down 3.3% last week, but that's after an upswing the prior week and still kind of idling near the midpoint of its longer-term multi-month range, going all the way back to the middle of last year or so. So kind of off and away by itself, crude oil. Gold higher, again, 3.9% last week. The dollar, though, interestingly, holding up relatively well, down only 0.1% against the euro for all of Friday's fireworks, and up a little bit against the yen, 0.4%. Bitcoin up 2.9% last week in all, but that's after a 6.9% drop. So over a 2-week period here, we get a large sell-off and a small rebound to retrace, but certainly the mood in Bitcoin still looking relatively heavy. Here's what we saw on Friday, thanks to that jobs report. S&P 500 down a little bit, 0.3%. NASDAQ flat. Yields taking a big hit. And, of course, we can see where those big weekly declines come from. Obviously, we can see that the lion's share of those moves seem to be on Friday. We likewise get a very convincing rise in gold again. The dollar is down 0.6% against the euro, 0.7 against the yen. Bitcoin gets most of its gains on Friday for the week, and the dollar would have had an up week across the board if not for these setbacks. So what happened with this jobs data? Well, we can see here that the headline number was vastly lower than expected. Only 22,000 jobs added, which is a pittance. 75K was the expectation, so it was already low, and now we've really undershot. The revisions were netting out to down 21K for the preceding month. So what have we learned here? Ostensibly that we added 1,000 net jobs in the latest iteration of the figures, which of course is not encouraging in the slightest. And the jobless rate in line, as expected, 4.3%, still relatively low by historical standards, but also the highest since 2021. So that much came in as anticipated, but that headline payrolls number clearly caught the markets in a tizzy, and we had first the markets jumping to celebrate that this would mean that more rate cuts are coming. The S&P initially rallied, then selling off, and ultimately, as we can see here, ending the day with a small loss, whereas it had been a large one earlier. Markets apparently don't think that 1,000 net jobs added in a given month is a good thing, or 22K even isn't a good thing. Shock of shocks, this starts the smack of recession risk, and so the markets are displeased. Now, we talked all of last week about how U.S. economic data has actually tended to surprise on the upside recently. Certainly the ISM numbers were a case in point, as were, for the most part, the other kind of contemporaneous indicators. And so we get this jobs report that's clearly on the weak side. Maybe what we're looking at is delay in sort of the usual way that jobs data tends to be lagged. Maybe we're looking at a kind of pickup in activity that hasn't spilled over into the labor market. We've heard the Fed talk about how the labor market is in a kind of strange state here, where there's not really aggressive firings, nor is there meaningful hiring. We're in a kind of equilibrium approaching situation where there's not demand for new hiring that's really powering a strong increase in payrolls, nor is there a shedding of labor forces. And so there's almost a kind of standstill. And this data would start to show us that, especially over the past 3 months or so. Not encouraging, but certainly not anything that necessarily tells stock markets this or that thing, and ultimately looks like that's why you get, despite a relatively strong showing for a bunch of other sort of Fed adjacent assets, obviously a strong showing for bonds, a strong showing for gold, a strong showing for currencies not named US dollar. That's why you seem to get this kind of soggy thing for stock markets on the whole. What's interesting then is that, at least on the rate side, the markets have clearly taken the hint. You can see now the likelihood that we don't get a cut is non-existent at this point, even a minor likelihood for next week's meeting. We're looking at a significant level of conviction at this point that there's going to be one cut, 88.2%. That there will be a cut of any kind is now a 100% likelihood, because there's now an almost 12% chance that we're going to get a 50 basis point cut this go around. Now, this much is probably non-controversial, at least that there's going to be some kind of a cut and that it's likely to be a 25 basis point cut. Markets have known this for quite some time at this point. Moreover, we can see that the way the markets are now setting up for this year and next, if anything, they're a little bit out on a ledge for next year now, having been essentially anchored around 50 basis points here since about the middle of May. Now we're slightly in the direction of a possible third rate cut this year. We've baked in 13 basis points out of that extra move from 50 up to 75. So about half of that move is now in the market. So we're basically saying, okay, we're about 50-50 chance on a third cut. But we've been at similar levels here, so it's not unheard of within this sort of range. But the Fed has been saying since December of last year that they're looking for 50 basis points this year. And we can see that the market has basically been anchored around that level, give or take some fuzz this or that way, since mid-May. Why is this significant? Well, we can see that at the beginning of the year, stock markets sold off and the Fed outlook got more dovish as we had this tariff rollout fuel concerns about economic growth. And we can see that right here. So this is a fear about the economy. In the dark line here is the S&P 500. Everything is going down at the same time. Now, you notice in early April, this is where you get Liberation Day and markets freak out. The president then comes out and goes, whoa, 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 90-day pause. The markets have gotten, quote unquote, yippee. And so the markets go, oh, okay, so I guess the White House is amenable to market discipline. I guess it does adjust what it thinks when the markets go haywire and signal you're doing the wrong thing. And so there is a sort of sentiment recovery. And you can see we come off the most dovish extremes here. Stocks do as well. And that takes us right into the middle of May. And this is where we get back to baseline. 50 basis points, as the Fed would have signaled it. Moreover, on stocks, we come back to the site of the break. So if this right here was the consolidation range near the top at the beginning of the year, and the break from that was somewhere around here, we'll look at where we come back to being just as we get this recovery here. And so what is that saying? Well, it seems to imply that whatever follows thereafter, once we get here, is no longer about an improving economic outlook or certainly a diffusing of the need for easing. Because we can see here for this calendar 2025, the markets basically return to where the Fed was at the beginning of the year. 50 basis points. This is where we started. This is what the Fed signaled in December. It's where the markets were before this move. It's where they come back to. But notice what happens thereafter. From there, it's the outlook for 2026 that starts to blow out. The sum starts to build out to a more dovish setting, and stock markets drift higher. So it seems like the rally for the better part of the past 5 months has been about little more, in this context, certainly. Surely there were some other influences too, but the most convincing story seems to be that it's about oncoming stimulus. It's about cheap money. And at this point, if we consider where we are numerically, we're already starting to exceed where that April bottom was. So, on the whole, the vulnerability here is the markets have become very dovish. The Fed is widely expected to do at least some amount of easing, so that much is non-controversial and probably not going to move the markets this way or that. The big question becomes, will they move their forecast? Which again, in June, had from 3.9 to 3.6 in 2026, just one rate cut. This is a move of 0.3, obviously rounded off from 0.25. This is a single move. Whereas for the Fed, in contrast with the markets, the gap is almost 50 basis points. A little bit more, in fact. And so this now sets up the risk in this Fed policy announcement coming out of last week, that the Fed isn't going to go the market's way. Now, why would that be? Well, maybe we'll find out this week, courtesy of U.S. inflation data. And we can see there's quite a bit of it on the menu. We already got an uptick in this survey of consumer inflation expectations. But the meat really is Wednesday and, of course, Thursday. Wednesday, we're going to get the PPI report. Thursday, we're going to get the CPI report. So this is wholesale inflation, retail inflation. And we can see here, we're expecting a relatively modest further increase in PPI, only 0.3% after 0.9% last month. The year-on-year figures here seen coming in a little bit, at least for the core, from 3.7 to 3.5. Headline seen holding unchanged. This will be very important stage setting for the CPI report to follow, because we've already seen in this PPI report this very significant jump in the July figures that told us we are now starting to see wholesalers really pass the cost of tariffs down to consumers. This mostly reflects rebuilding margins after this period of weakness here at the start of the year, where businesses basically said, we're going to eat the tariff costs. We're not going to pass it on to consumers. We're going to take the tariff costs out of our own profit margins, and we're going to insulate consumers lest we destroy demand for our own stuff without knowing what the tariffs are really going to do. Well, now it looks like they've decided they have enough conviction to say, you know what, consumers, you pay for it. And so margins have built back out, and so you get this sharp jump in wholesale inflation. We'll see if that continues to surprise higher in this go-around. And of course, if it does, it'll be good stage setting for this, the main story. The headline inflation rate seen going up from 2.7 to 2.9. The core rate seen holding at 3.1. We can see that here. If this were to surprise on the top side, then of course the likelihood that the Fed would meet the markets where they are on this expansive 2026 outlook would be significantly diminished. There'd be a lot of consternation perhaps about a Fed that surprises on the hawkish side, not because it doesn't cut, but because it doesn't endorse this expansive dovish outlook thereafter, beyond the calendar turn to 2026. And certainly if the PPI numbers are hot going into the CPI report, the concern would be that this too would start to roll up and get the Fed into a more sort of concern about inflation becoming sticky were they to act with more conviction. And we see that in the sort of last bit of data here for the end of the week. We're going to get the University of Michigan Consumer Confidence Survey, and that's got an inflation expectations component, in particular this one-year inflation expectations component. It was 4.8 last time, which is a rebound. We'd started to come down from kind of April's peaks where there was that freak out around Liberation Day. That was a peak of 6.6. And we can see here that really since the COVID inflation scare reached its peak and the Fed started to really hike rates in early 2022, and until this tariff spook, the trend has been lower inflation expectations, improved consumer confidence, until we get into the beginning of this year. And it's here that we start seeing, oh, tariffs, inflation expectations come back up, consumer confidence falls back down. We'll see how overall consumers' mood holds up. Of course, we've already had very weak consumption in the first half of this year, the weakest, in fact, the weakest 6 months since the first 6 months of 2020, which is the COVID recession onset. And so already there is a sense that consumers are feeling The pain and the pass through, as we just saw, is only just getting started. If that continues, then indeed we might have a further pickup in inflation expectations. The Fed would certainly worry about that becoming entrenched, and that could limit their scope for easing next year, at least in their mind, which would be at odds with where the markets are. And that, of course, creates a significant risk for stocks. I mean, if you thought that much of this was contingent on what's going on here, at least to some extent, at least let's say for half of the move, well, then you have a meaningful discount here if these expansive expectations are not met. And moreover, if we consider what the dollar is doing, it's of course a little bit down in the wake of the jobs data on Friday, but it hasn't made a lower low of consequence since the beginning of July. Meanwhile, as we just saw, gold is surging, bond yields are cracking lower in earnest. The outlook for the Fed is becoming ever more dovish, but the dollar strangely seems like it's done declining. It hasn't found the impetus for a rally. Certainly, if the Fed were to leave the markets hanging on next year's rate cut outlook, that would start to look like a reason for the dollar to go up in earnest, especially if it were powered by risk aversion as well as a rethink on Fed policy expectations. So we have a situation where the market seems to be sniffing out something. Maybe a turn in stocks, maybe a turn in the dollar, and this inflation data is going to be critical stage setting for what may happen then next week to really catalyze these changes. Outside of the U.S., we've got a monetary policy announcement from the ECB. We see here no changes being baked in. So the current rate here, the baseline deposit rate stuck at 2, and we can see through the rest of the year, these month-based Ionia futures are telling us we're shy of 1.75. In other words, there's no cut that's baked in, and we can see that here. The change here only about a 5 basis point cut that's baked in. For next year, again, a pittance, only about 8-9 basis points in a cut that's priced in for next year. In other words, we're looking at stasis on ECB rates. We'll see what they say. We'll see how that influences the equation here. But of course, it's coming out the same day as the CPI report. So this might be something of a non-event this go-round. We're also going to get a bit of data out of China, in particular the inflation report coming on Wednesday ahead of PPI in the U.S. So perhaps we get a little bit more maneuver there. And what's interesting is that year on year, we're still expecting ongoing deflation for wholesale prices, but for CPI, we're expected to come in from flat to, again, negative 0.2%, essentially saying there's no demand to speak of in the world's second largest economy still. It's now been mired in economy-wide deflation for 9 consecutive quarters. There's been some stirrings of activity, perhaps, but consumers over there still seem perfectly content to stash their money into savings accounts, and there's really no demand to speak of to power the economy forward. So if the U.S. economy were to falter, we really don't have a plan B. Europe is at standstill, as evidenced by stasis at the ECB, among other things, and China still can't get the engine revving, going on 2 years now. So as we look at what's going on then, it really is all about the U.S. Over the weekend, we had some data out of China on the trade side, which we can see gave us cooling exports and imports. So it really is about the Fed. It really is about the U.S. economy, because without that, we don't really have much of a global business cycle catalyst to speak of. As far as positioning goes, still familiar exposure, not really much to update here. Still long the dollar, looking for it to bottom, long it against the Aussie, so short that, the pound, the euro, and the Canadian dollar. Still looking at long gold, short the put there in GLD at 330, and of course it's working a bit here. Short a bit of Bitcoin. These puts very cheap, and so looking for that to essentially be a little bit of a kicker on this general risk-off bias, looking for stocks to maybe start to look for a top here, or at least the risk-reward on that to look attractive. So still holding these put verticals in the NASDAQ and the S&P 500, and enjoying the rebound in bonds. This is finally working. I was sitting in these positions for 2 months before there was any kind of movement in them, but these call verticals in the long end of the curve finally working, and no reason to get off the boat now, much like gold, until at least there's some kind of a downtick. And that is macro money for today. As ever, here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom, commenting at Ilias Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
What's your sleeper pick for the second half of 2025? Is there anything that you're particularly high on nobody's talking about?
My sleeper pick. I think Ethereum is an interesting play. It's still a lot. It's near the lower end of where it's been trading at 2,500-ish. If you are bullish on the crypto space, which I am, and I think the blockchain technology is a huge part of that, I think that Ethereum has a little bit of a catch-up trade, and you can now trade it via the ETFs. ETH-A is the Ethereum ETF, which is now accessible for option traders. So I think that's an interesting play.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really tastylive until about 2012. It made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with research. They share that research. It's not just trust us and do this, which is a very dangerous thing in the financial world. But learning about that in a Tasty universe, it starts to prove itself out, right? When you follow the methodology, you'll see those profits and you'll understand why a position did what it did. Sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
All right, we're back. Tasty Crypto Show. I'm Dan Cecilia, and today we've got Greg Magadini, professional options trader and head of derivatives at Amber Data, back on the show. If you're not familiar with Greg, he's a regular on the network and always brings us really unique insights and trade ideas from the crypto options market. Greg, it's a pleasure to have you here. Love chatting with you. How's it going?
Thanks so much, Dan. Happy to be here. Going well. A lot of exciting things happening. We got some interesting Fed rate repricing and some effects in the gold market and crypto market. So I'm excited to talk about all that stuff.
Yeah, for sure. And I think we'll just dive in. Obviously, I love reading your newsletter, love, the stuff you've been publishing over at Amber Data. So let's just get into that and just do, start off with a crypto market discussion. After last week's payroll data, there was a drop in that interest rate expectation that fueled kind of a bit of a rally toward the end of the week. But you mentioned crypto prices didn't follow. Do you know what the reason is for that divergence, or do you have any insight there?
Yeah, so it's very interesting because obviously gold is a lower volatility asset than Bitcoin. So gold vol, if you look at the GVZ, which is the gold vol index, it's about 19. DVol, which is the Deribit Bitcoin Vol Index, again, 30-day VIX style index, has about 37. And you had, almost 5% rally in gold and almost no movement in Bitcoin itself. So my base case scenario is that Bitcoin is a little bit of a mix of digital gold and risk assets. And I think it's a little bit of a tell to see the risk asset component underperform. So the first thing I just want to show here, if we look at the CME Fed Watch tool, that's showing us the implied probabilities of a Fed rate cut in September. So we can see here the probability of a zero rate cut is now 0%. It was about 14% last week. And if we go out to October, the probability of 2 rate cuts went from 48% to 71% week over week. So you're getting cheaper money being priced into the market. Now, what's really interesting about that is that markets are forward looking. So the markets, the risk assets are rallying on the back of that. But once that's priced in, what's the safety net? So to me, seeing crypto underperform a little bit is a little bit of a note of caution. Obviously, the trend is higher, so you don't want to fight the trend, but we got to think about how can we hedge out sort of that risk asset component and maybe isolate the digital gold component. Just for context, the market cap of gold is about 24 trillion, and the market cap of Bitcoin is about 2.2 trillion. So Bitcoin's only 9% of gold. All of crypto is only equivalent to Nvidia's market cap. So crypto's still small. There's still a lot of upside. But that being said, it is a bit of a risk asset, and I have some vol data to sort of confirm that narrative. But happy to just pause it there and kind of take it from there.
Yeah, for sure. I think what's interesting is you kind of label this theme where there's this bad news is good news for risk assets, but I think what you're mentioning is we're starting to see Bitcoin's kind of a tell, right? Bitcoin isn't moving with gold, and it's even with these rate cuts priced in, we're still typically that's what positive and bullish for risk assets. We're not seeing Bitcoin and crypto move that much. So is that more of a tell to hey, maybe there's some risks here, or maybe it's priced in and we're just not getting, maybe it's time for a caution or time for pause. Do you think that's what it is? Is it kind of hey, maybe after September, we're not totally sure where things are going?
Yeah, I think there's kind of two things to look at that really paint this picture for me. So let me show you this chart right here. I think this is very interesting. Okay. So this is 180 days till expiration, 25 delta risk reversal. So that's looking at 25 delta call implied vol minus the 25 delta put implied vol. So when we're above zero, calls are more expensive. When we're below zero, puts are more expensive. So we could see back in the 2022 era, when we had, a lot of interesting things. We had the FTX crisis, we had the Terra Luna crisis, we had Three Arrows Capital going bust, all those things. We were in that negative risk reversal zone. And then we had a brief dip here in the SVB banking crisis. Again, that was a kind of a moment for crypto as well, especially the stablecoin world. So we got a quick dip and then just bounced back. And ever since then, the vol profile has been to the upside for Bitcoin. So the option market was pricing in positive spot vol correlation, which is the opposite of equities. Equities typically have negative spot vol correlation. Gold can go both ways. And so what we're seeing here in crypto is, as of, call it last week, the long dated relationship of the spot vol correlation being priced into the vol surface just flipped into the negative, not by a lot, but just by a little bit. So there's kind of two things I'm thinking there. One is, are people hedging? Are people essentially, feeling bearish? Or is it more that we now have institutional investors holding Bitcoin, selling covered calls, typical type of risk profiles that equity investors would put on in terms of options? And so maybe the investor base is the same investor base that invests in equity indexes and are just doing a sell the covered call, buy the put as security type of flows. But regardless of the reasoning, that the outcome is the same. If the equity investors are kind of repricing the vol surface because they're selling covered calls and buying puts, and it's reflecting in that negative risk reversal, that still means that if equities crash, they're going to be the ones who liquidate. So I think it's kind of a tell to just see that long dated relationship start to become negative for the first time in almost 3 years, or I'll call it 2 years now, 2.5 years.
Yeah, that is a really interesting chart, and I think I do sense too, because like I personally look at a lot of like what's going on in the market sentiment wise, right? Like I'm big on Twitter. I'm listening to kind of like the talking heads of the space, and you're beginning to see that. I don't want to say chaos, but like, with all these announcements of these treasury companies, and now, I saw WorldCoin one just announced today. There's all these like altcoins that are sort of establishing themselves with these treasury companies. And, on the back of that, we had some of this, economic data that didn't really come in that well. It gives me pause as somebody in the market, as somebody who's been in the market for a while, because it's just like, how many of these treasury companies can we support? How many of these tokens can we support? So it's just interesting to see that that's turned negative, that there's a signal there. And the last time we kind of saw that was something broke essentially, or some things crashed. So, maybe to your point, it is sort of just a short-term thing, or it kind of, maybe it dips below and comes back. But yeah, that term structure is, or the risk reversal rather, is an interesting one to take a look at. Anything else? How about ETH? Because for a while, the last couple of times we've had you on the show, we talked about that relationship with implied to realized vol on Bitcoin, being that realized vol ends up coming in lower, so there's more premium there. But ETH, you mentioned you were bullish on ETH. So is there anything that you're looking at in ETH, maybe the term structure, or just sort of ETH spot?
Yeah, I would love to jump into ETH because I think there's some really interesting trades. I think just before I jump into there, I do want to talk about sort of where VIX is at, because VIX is a really interesting way to hedge out risk on versus risk off type of events. And so even though Bitcoin is starting to price in a little bit of risk off hedges, where hedges are still cheap is the VIX complex. So let me just show you what I mean here. So first of all, if we look at commitment of traders, the CFTC COT report, we can see large traders are essentially short VIX futures to a level that we haven't seen in years. So the positioning in the VIX market is extremely short. So that's kind of interesting. Then if we look at the relationship between cash VIX versus front month future VIX, we can see it's kind of middle of the range. So cash is about, $1.50 below front month future. But what gets really interesting is if we look at front month future versus next future out, which would be September versus October, what we see here, and this is a 5-year chart. So this is weekly data on a 5-year chart. I mean, the contango extremity between September versus October VIX is the lowest we've seen in 5 years, essentially. Now, something that's really interesting to note is that the expiration of the September VIX future is on September 17th, which is the day of the FOMC rate decision. So the VIX is going to expire in the morning, and then at 2 p.m., we'll get the FOMC rate decision. So what I think is happening is that risk sentiment is at extremely bullish levels, almost complacent, you could say, because we're pricing in sort of that rate cut. So what's interesting is if you want to get long Bitcoin, but you want to hedge out some of the risk off uncertainty, the VIX complex is really cheap right now. So you can essentially get long Bitcoin and do a dirty hedge in the VIX complex and kind of do that type of trade. So I think that's an interesting positioning. The other thing that we just chatted about, or you were asking about, is Ethereum. So Ethereum, I'm still bullish Ethereum. The trend is still higher. We're right below all-time highs, but I think it's logical that we consolidate a little bit below the 5K level. Prices have to trade here to make sure that they're concrete, so to speak. But what we see is we have an extremely flat term structure in terms of Ethereum. So if I look at this chart, let me just show you the term structure real quick with a live chart. So we can see here with a live chart, let me take off the forward vol. So you can see, forget the dailies at the very, very front, but if you just go to, September 19th, so that's next Friday versus end of year, I mean, it's basically the same ball. So the reason why that's interesting is if we jump back to this chart, this is showing us term structure richness. It's showing us the average differential between key expirations, 30 days, 60 days, all the way out to 6 months. And so when we're below 1.0, we're in contango. When we're above 1.0, we're in backwardation. And right now we're at this very, very, very flat term structure. So in my mind, this is kind of an interesting setup. I can buy, say, October upside calls, call it a 25 delta call, and I pay 65 vol. And then I can sell the September 19th 25 delta call and get paid 65 vol for that. And the idea here is that as we sort of consolidate that short diagonal call, the short September contract is going to fall off, or as days go by, I pick up deltas as that short contract kind of decays pretty quickly. And then if the market rips, we have a good stop level. We know that breaking past that 5,000 level is a time you would take off that trade. But the hope is that time goes by and then we kind of break out after that first front month contract approaches expiration or actually expires. October is going to be key for Ethereum. We're going to get, it's rumored that we're going to get the SEC approval or denial of staking ETFs, staking yields.
Okay.
And so if we get staking yields in Ethereum, that's a catalyst for higher prices, in my opinion. So that's a really interesting sort of setup.
Yeah, no, that is interesting. So let me just take a step back just so we can kind of go over, because there's a lot of stuff here. So the first one I want to go back to is getting long is the VIX Bitcoin trade that you talked about, where you could be long just spot Bitcoin, right? Or whatever Bitcoin ETF, but you're hedging that by buying buying calls on the VIX essentially to kind of hedge that risk if VIX spikes. So if risk off spikes.
There's a few ways you could do it, but essentially, yeah, you want long delta exposure. So you could do that by doing a couple things. You could sell, put spreads on UVXY or UVIX or some of those ETPs a little bit out of the money. You use that premium to buy some of that long dated Bitcoin call that's trading at a discount compared to puts. That's kind of an interesting structure to play. You could just buy Bitcoin outright and buy a couple calls or call spreads on VIX, with the idea that if Bitcoin dips, you're going to get some sort of rally in the VIX as well if it's a risk off move. So those are kind of two things you could do. So yeah.
Okay, and would you do that in the October expiry?
Yeah, I think the October expiry is really interesting. So September, so there's kind of two things here. So September is pretty cheap right now, so I wouldn't be surprised if there's a little bit of an up move towards mean reversion in the September futures, which would help out those ETPs. But I think that the true move is going to be a pretty firm VIX in the month of October after rate rallies have been fully priced in, and then we see what happens.
Gotcha. Okay, cool. And then, so we can do any number of those things, just using VIX kind of as that risk off hedge. And then ETH, in the past we talked about this, and I actually put this on. We talked about that micro strategy, sell the premium micro strategy, go out and buy ETH, ETH ETF. But for this one with this, the flatness of this term structure on ETH, what are you looking at there? Is it just 25 delta call in October because you think that there's this catalyst for the staking yields getting approved by the SEC? Do you think is that a catalyst you think to push ETH above 5K, or play for that basically?
Yep. So I would look at something like selling the September 26th expiration, the 37.5 call, and then I would go to like the October 24th expiration and buy the 42 call. So that's about delta neutral between the two. I think that spread's about 33 cents. And the idea here is you put that spread on. The worst case scenario is the differential between these two strikes. So if ETH starts to break above the 5K level, that puts the ETF at about $39. That would be sort of the worst case outcome, and you would take a loss. If we kind of just hang out here and continue to consolidate and sort of grind higher into October, that front month contract should roll off before we get to that 37.5 level, and then by that expiration, you have kind of a fully outright call, and typically I would take some off at that point and maybe let a couple ride.
Gotcha. Okay. So we're looking at September 26th, selling the 37.5 call, and then buying the October 24th 40. You said 40, 40-ish? 42.
Yep.
Yeah. Okay. So we're looking at 30 cents, 31 cents. Yeah. Okay. Delta is about delta neutral. It's about 0.3 delta. Yeah. Okay. Yeah. So, and you're just waiting. And basically what we're doing here is hopefully that front month just kind of rolls off and we play for that up move in October.
Yep.
Okay.
So my thinking is October remains firm, sort of because of that catalyst. My thinking is that the front month vol comes down because we kind of consolidate below all-time highs. ETH finds its footing. And so each day that goes by, I pick up deltas.
Okay. Okay. Awesome. Is there anything that you could see that might kind of, I guess, nullify this outlook? Is it more bad data? Is it, I don't know, they pause interest rates? Is there anything on the horizon you're like, maybe we take a step back and, maybe not go? Yeah. Yeah.
So the wild card is inflation data. So we got PPI tomorrow. We got CPI on Wednesday. If we're starting to get hot inflation prints, rates are going to reprice the other way, which will be great for that VIX hedge. But it's going to change the profile of the path of rates.
And and have you been tracking that? Like, is there anything you're looking at that could give us an insight into this inflation, or do we think that's why the probabilities have shifted to rate cuts, 2 rate cuts? Do you have a sense of inflation?
No one really knows, but obviously Powell kind of shifted towards labor market being a little bit more important versus inflation on his Jackson Hole speech. But obviously, the inflation data depends how it comes out. The one thing to keep in mind is that a year ago, when the Fed cut 50 basis points, inflation was lower. And today, rates are lower and inflation is higher. So if we get bad inflation prints, it's going to look tough for rate cuts in a rate environment. But we'll see how that goes. The one thing that is cheap is energy. I think sort of the Trump policy is to do deregulation on energy and do negotiations with energy trading partners. And so we've seen gas, WTI be pretty low, natural gas be pretty low. So I think his thinking is that if I keep energy prices down, that should combat any sort of inflationary forces. But we'll see. It's hard to tell. I don't think anyone knows.
I would love to actually dig into some of the energy. Do you trade that at all? The future energy futures or like oil future?
No.
Okay.
No, it's not something I look at.
Yeah. Okay. How about gold? Do you think gold's telling us any? I know we talked about this a little bit earlier, where that divergence between gold and Bitcoin could be a tell, but is gold telling us anything about inflation, you think?
So yes, I think gold is telling us quite an interesting story about inflation expectations. This is a gold rally that I haven't seen in my trading career, really. So
yeah,
it's
yeah.
That's why I do think the gold profile is bullish for Bitcoin. I do think it's relevant that gold has such a bigger market cap than Bitcoin. But it's something to keep in mind. And the risk reversal in gold is positive right now by about a full percentage point. So that 25 delta call is about 1% more expensive than a 25 delta put.
Gotcha. Okay. And then because, and I know like in your newsletter, you have, you kind of follow some of the institutional flows in Bitcoin options, ETH options, crypto options in general. Is there anything you've looked at? Like, is there any big noticeable structures or anything, positioning that is interesting or standing out to you? Block trades, anything there?
Yeah, actually, so when we look at if we look at the risk reversal in Ethereum, ETH tried to get to that $5,000 level back in August 24th area, 24th, 25th, got instantly rejected. That flipped that risk reversal into negative territory, and we haven't been able to kind of get back into that positive territory, which that's why I'm thinking there's a little bit of consolidation period here. And if we look at the gamma exposure, so how dealers are positioned on Darebit, dealers are short a lot of gamma around 4K to 4,200. So that's typically the street buying put options around the 4K level as a significant level. And then they're also short the 5K level. That would be the street buying 5K calls. So that's really where, lines in the sand are being drawn right now. And sort of that put buying action is what's causing that risk reversal to be so negative, and the front end of the term structure to be so firm.
Gotcha. Okay. And what is that like? If they're short, if dealers are short that 5K gamma and then they're long buying puts essentially in that 4K, if we get to those levels, does that like, do you expect like violent moves down? Does that kind of cause any type of move in the price? From that positioning.
So I'd say dealers are short on the 5K and short at the 4K level.
Sure.
In the street would be long on those. So typically the option market is big enough to like cause sort of acceleration movements in those type of zones. I would say crypto vol is still relatively small compared to the underlying market caps. So as of this point, I don't think the gamma rebalancing is necessarily an accelerant, but it's a good sign of sentiment of where sort of option activity is being drawn. And so in my mind, what I'm seeing here is that this sentiment helps explain the vol surface and how people are looking at potential price movements in ETH in the short term here.
Gotcha. Okay. Yeah. So we got about a minute left, Greg. Anything else you want to add in or let the viewers know, or just, where they can follow you?
Yeah, absolutely. So if anyone wants to check out some of these charts and look at IBIT volatility, Coinbase volatility, MicroStrategy, or Darebit vol, or anything like that, you can go to our application, pro.amberdata.io. And then if you want to read our weekly notes on the vol market and what's going on in the space, you can go to amberdataderivative.substack.com.
Awesome. Well, that's Greg. We love having you on. Appreciate you joining the show. We'll have you on again in a couple weeks. Obviously, we want to take a look and see how everything shapes out over the next couple weeks here. Obviously into October. Appreciate you coming on, and we'll chat again soon. So that's all we have today. Yeah, that's all we have today. We'll see you guys next time. Peace.